Hi friends, and welcome back. If you're serious about building long-term wealth without picking stocks or time the market or searching for the next Tesla, you really want to hear this. Because today we're talking about the most common myths on capital markets, that you can outperform the market in the long term. And with all the recent noises about the Trump tariffs and the reaction of the market to these, I had a lot of people question whether I'm changing my strategy on capital markets and long-term wealth building. They're asking me, are you changing your investment strategy? My simple answer is no, I don't. And before I explain to you why, leave a like and subscribe to the channel so you don't miss out the next videos. But now, let's get into it. Number one, why trying to beat the market is a losing game. Let's start with a simple truth. You're not going to beat the market. Not consistently, not in the long term. And honestly, neither your favorite hedge fund manager like Bill Ackman or Ray Dalio. Here's a chart that says it all. Over a 15-year period, more than 90% of all actively managed funds underperform the S&P 500. Let that sink in. All these analysts, algorithms, teams, professionals with all these Bloomberg terminals don't outperform the S&P 500 in the longer term. They make millions of dollars in personal income and still don't win. Now, imagine you, a part-time investor with a full-time job trying to squeeze a trade between two meetings. It's just not a realistic battle to win. Number two, the problem with reacting to news. Let's talk about something that recently happened, the Trump tariffs. His administration announced high tariffs on China, Europe, and all the countries around the world. Markets dipped, commentators panicked, and suddenly everyone became a geopolitical strategist on any strategy consulting company. I had people texting me, should I sell my tech stocks? Should I buy into real estate? Are we heading to a trade war? I don't know. But here's what I told them. None of it changes my investment plans. Why? Because short-term political shocks are just that, short-term. We have seen tariffs before. We have seen presidents come and go, markets absorb, and then move on. If you're reacting to every policy headline, you're not investing, you're gambling. Number three, why index investing wins long term. Now, let's talk about what does work. Long-term passive index investing. Here's why. It's simple, it's low cost, it removes emotions, and it performs better than almost every other trading strategy. But I have to admit, it's sometimes a little bit boring. When you buy a broad index like the S&P 500, you're not betting on one company's innovations, but you're betting on global innovation. You're betting that over the next 10, 20, 30 years, the world will continue to grow, adapt, and solve big problems. And you know what? History shows that's exactly what happens. I know history is not a reference for the future, but it's most likely. Number four, visual. S&P 500 over time. Take a look at the chart of the S&P 500 over the past 40 years. You will see crashes, tariffs, elections, wars, pandemics, and yet the trend is up and to the right. That's why we follow the market. Not because it's exciting, but because it works. Number four, stick to your plan. Let's go back to what I said earlier. People asked me whether I changed my investment strategy after the tariff news. Here's the truth. If your investment plan changes every time the news cycles changes, you don't have investment strategy, you have a panic button. Instead, build a real plan. Define your goals. Choose your risk profile. Search for a low-cost index fund set, rebalance once a year, and automate your contributions. 5 points. Then ignore the noise. You are not Warren Buffett. You're not trying to beat the market or anyone else. You're building wealth quietly, slowly, and consistently. Key principles of smart long-term investing. Let me give you 5 key principles that help me stay on course. Number 1, time in the market beats timing the market. Number 2, diversification protects you from being wrong. Number 3, costs matter. Minimize fees whenever possible. Number 4, consistency compounds. Invest monthly no matter what. Your emotions are your biggest risks. Learn to manage them. If you internalize just these 5 ideas, you're ahead of 90% of all retail investors. Number 7, want to go deeper? If you want to go deeper, here are 3 books I highly recommend. The Little Book of Common Sense Investing by John Bogle, a timeless classic from the founder of Vanguard, all about the power of index investing. The second book is The Psychology of Money by Morgan Housel. It teaches you how your mindset and behavior impacts investing more than you think. And number 3 is The Joys of Compounding by Gautam Bait. It's my favorite book and it's about investing, compounding, productivity and lifelong learning and how he became a hedge fund manager into the Indian market. And no, they're not full of hype. Some of them are really famous and some aren't, but they're full of truth. So, the next time someone asks whether you're changing your investment strategy based on news, elections, wars, tariffs, policies, and pandemic, you know what you'll say. No, you're not changing. You're confident on your long-term strategy. You're investing long-term into the market. You're not a gambler. Stick to the stuff you know. If this video helped you to rethink your investment strategy and to stick to your long-term investment plans, it would be great if you give this video a like and subscribe to the channel so you don't miss out on the next videos. I would love to see you on the next one. Leave a comment with your next investment ideas or videos I can do. And I see you in the next one. Cheers.